Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest technology updates in digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at 10 a.m. and 6 p.m. Eastern Standard Time. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Something just shifted in the XRP narrative this week, and it wasn't just price action. Three separate developments landed almost back to back, and when you connect them, they paint a much bigger picture than most investors realize. A major regulatory framework is advancing in Washington. The White House is openly discussing crypto payment integration, and institutional signals across traditional finance are flashing risk on at the exact same moment. Now, individually, each story matters, but together, that's where things start getting really interesting. Because what we're maybe witnessing right now is not just another crypto cycle headline, but the early stages of a structural transition and how digital assets are treated inside the United States financial system. And XRP sits directly in the middle of that conversation. Not because of hype, not because of moonboy predictions, but because XRP has always been tied to one thing most crypto projects never focused on: payments, liquidity, settlement infrastructure. And when policy, banking, liquidity conditions begin shifting simultaneously, markets pay attention. Now, none of this guarantees price. Nothing here guarantees adoption tomorrow morning. But short-term noise, long-term structure, I always say. And right now, the structure is changing fast. So in this video, we're going to break down the three major shifts almost nobody's connecting together. Why institutions may be looking at this moment differently, and why some analysts believe the next phase of crypto could look very different from the last one. Because price is reacting, but the system is evolving. Let's get into it. To understand why these developments matter, we need to zoom out first. Because one of the biggest mistakes investors make, especially in the crypto arena, is looking at assets in isolation. They stare at candles, charts, hourly volatility. But major financial transitions rarely begin with price, ladies and gentlemen. Write that down. That's massive. They begin with liquidity conditions, regulatory posture, institutional confidence, and changes in how governments frame emerging technology. That's why the first shift this week may actually be the most important backdrop of all. The S&P 500 crossed above 7,400 for the first time in history. The NASDAQ simultaneously pushed to new all-time highs. And while traditional finance headlines celebrated equities, something deeper was happening underneath the surface. Risk appetite was expanding. Now, this is what most people miss. Institutional capital does not move emotionally. It moves structurally. When large funds, banks, and asset managers become more comfortable allocating capital to higher risk environments, liquidity begins searching for asymmetrical opportunities. Historically, that has mattered enormously for crypto. Not every time, not perfectly, but repeatedly. We saw versions of this during the post-2008 liquidity era. We saw it during the pandemic stimulus cycle. And we saw it during periods where monetary conditions pushed investors further out on the risk curve. Because when confidence expands, speculative and emerging asset classes often benefit downstream. And this is where history becomes incredibly important. Back in the late stages of the Roman Republic, trade networks expanded faster than the systems governing them. Merchants moved wealth across regions more efficiently than old infrastructure could handle. The result wasn't immediate collapse, it was transition. Financial systems began evolving because commerce itself demanded something faster, broader, and more interconnected. Today, digital settlement networks are creating a similar pressure on legacy infrastructure. Not identical, but rhyming. Cross-border payments remain slow. Settlement layers remain fragmented. Intermediaries still absorb enormous fees. And for years, crypto largely existed outside serious institutional consideration. But now, governments are beginning to discuss integration instead of prohibition. That distinction matters more than most people realize. Because once policy discussions shift from how do we stop this to how do we regulate and utilize this, the conversation changes permanently. And that brings us directly into the second major shift, the Clarity Act. Now, if you've been following crypto regulation closely, you already know that this is becoming one of the most important legislative discussions in the United States digital asset market. Because for years, one question has hovered over the industry. What exactly is a crypto asset under U.S. law? Security, commodity, payment instrument, something else entirely? That uncertainty created hesitation, especially for banks, especially for institutions, and especially for companies afraid of regulatory retaliation. But the Clarity Act aims to establish a more defined framework around digital assets and jurisdictional oversight. And for XRP specifically, that matters enormously because XRP has spent years inside one of the most watched legal battles in crypto history involving the SEC and Ripple. Now, some analysts argue that clearer statutory definitions could dramatically reduce uncertainty surrounding secondary market activity. And that's important because institutions hate ambiguity. They can manage risk, they can manage volatility, but uncertainty around legality, that becomes a completely different problem. Now, here's where things become even more interesting. Certain interpretations of the framework suggest prior federal rulings regarding digital asset classification could carry meaningful weight moving forward. If that interpretation holds, many investors believe it could reinforce broader legal clarity surrounding XRP secondary sales. Again, nothing is final until legislation fully develops. But directionally, that signal matters because institutions don't wait until the final headline to position themselves. They watch trajectories, and the trajectory right now appears dramatically different than it did even a year ago. Now, this is where the macro story connects directly to crypto infrastructure, because buried inside many of these legislative discussions is another massive issue: banks. Specifically, what banks may eventually be permitted to do with blockchain-based assets and settlement systems. For years, crypto and banking operated like separate worlds. Traditional finance viewed crypto cautiously. Crypto viewed banks as obsolete. But that divide may slowly be collapsing. Some analysts believe the next stage of adoption won't come primarily from retail speculation, but from institutional integration. That means custody, settlement, tokenization, cross-border liquidity, and potentially the use of blockchain rails underneath existing financial systems. That's why XRP continues appearing in these conversations, not because it's the only project in the space, but because it was specifically designed around payment efficiency and settlement speed from the beginning. Investors agree with this thesis or not, XRP's positioning inside the payments narrative has always differentiated it from purely speculative crypto assets. And if banks eventually begin utilizing blockchain infrastructure at larger scale, that conversation becomes far more relevant. Now let's move to the third shift, because this one may be the most underappreciated development of the entire week. The White House discussing crypto payment usability. That's a huge distinction. For years, one of the biggest barriers preventing everyday crypto usage in the United States has been taxation complexity. Technically, every crypto transaction can trigger a taxable event. Buy a coffee with crypto, potential tax reporting issue. Move assets around, potential reporting issue. That creates friction, massive friction. Let that sink in, ladies and gentlemen. This is huge. But recent discussions around a possible de minimis tax exemption for smaller crypto transactions suggest policymakers may finally be recognizing this problem directly. And if smaller crypto payments become easier for a compliance perspective, that changes the conversation around usability entirely. This is massive because now we're no longer talking only about crypto as a speculative investment. We're talking about crypto functioning operationally, as infrastructure, as a payment layer. And for XRP, that matters because the entire network narrative has always centered around efficient value transfer, fast settlement, low transaction costs, cross-border utility. Now again, none of this guarantees XRP adoption. Let's be very clear about that. But policy discussions themselves reveal something very important. The framing is changing. And in markets, framing changes often arrive before adoption waves. Think about the early internet in the 1990s. Many governments initially treated the internet cautiously. Some viewed it as dangerous, unstable, economically disruptive. But eventually, the conversation shifted from resistance to infrastructure development. That shift changed everything. The companies positioned correctly before mass adoption benefited enormously from the structural transition that followed. Crypto may be entering a similar phase now. Not identical, but directionally similar. The conversation is slowly moving from should this exist to how do we integrate it responsibly. That's a completely different environment, ladies and gentlemen. And here's another piece almost nobody's talking about, which I find very, very amazing. Self-custody protections. One of the major concerns within crypto has always been whether decentralized wallets and self-custodial interfaces could face aggressive regulatory restrictions. Because if users cannot directly control digital assets, then much of the crypto's foundational philosophy changes. This week, major industry participants pushed back strongly on attempts to classify decentralized wallet infrastructure under traditional securities frameworks. And that matters far beyond Ethereum or MetaMasks. Let that sink in and write this down. It matters for the entire digital asset ecosystem. Because if regulators ultimately establish clearer distinctions protecting self-custody infrastructure, that could remove another major layer of uncertainty hanging over the market. Now, this is what most people miss. Institutional adoption and self-custody are often presented as opposites, but they may actually evolve together. Large institutions want compliant frameworks. Retail users want asset control. Future systems may need both, and that balance could define the next decade of crypto evolution. Now, when you combine all three shifts together, the macro picture begins looking very different. You have a historic risk on environment in traditional markets, a regulatory framework moving toward greater clarity, and policymakers openly discussing crypto integration into payment systems. Individually, each matters. Together, they create a narrative convergence. And narrative convergence is powerful in financial markets. Major cycles rarely emerge from a single catalyst. They emerge when liquidity regulation, technology, and investor psychology begin aligning simultaneously. That's why some investors are watching this moment so closely, not because of one news headline, but because multiple structural signals are appearing at the same time. And this is where another historical parallel becomes useful. During the Industrial Revolution, railroads were initially dismissed by many established financial elites as speculative and unnecessary. But once governments, banks, and commerce aligned around the infrastructure opportunity, railroad networks transformed entire economies. The important part wasn't just the technology itself. It was institutional integration. Blockchain infrastructure may eventually face a similar transition. Not every project survives. Not every narrative succeeds. But once institutions begin building around infrastructure, momentum can accelerate quickly. And right now, crypto appears closer to institutional integration than outright rejection. That is a meaningful distinction. Now let's talk specifically about XRP, the anointed one again. Because regardless of where someone stands emotionally on XRP, one reality remains true. XRP has spent years positioning around global payment efficiency. That's the core narrative, and suddenly the broader environment is beginning to discuss exactly those issues. Settlement efficiency, cross-border movement, banking integration, regulatory clarity, payment usability. Those themes are no longer niche crypto discussions. They're entering mainstream policy conversations. That alone changes perception. Now, perception does not guarantee outcome. Very important distinction, ladies and gentlemen. There are still risks. Legislation can change. Regulatory frameworks can evolve unexpectedly. Markets can reverse violently. And crypto remains one of the most volatile sectors on earth. But structurally, developments matter because they influence long-term trajectories. Short-term noise, long-term structure, I would say. And right now, the structure appears to be evolving faster than many expected. Now let's address something critically important. A lot of people watching videos online are searching for certainty. They want guarantees, price predictions, specific timelines. But markets don't work that way, especially emerging markets. The internet bubble taught us that revolutionary technology can absolutely change the world while still producing brutal volatility and failed companies along the way. Some crypto projects may thrive, others may disappear entirely. The goal is not blind belief. The goal is understanding the broader transition taking place underneath the headlines. And right now, there's a growing argument that digital assets are slowly moving from speculative outsiders toward regulated components of the financial system. That transition matters more than daily price action, ladies and gentlemen, because price reacts, but systems evolve slowly over time. And once systems begin changing, capital often flows. Now, here's something else investors should keep watching carefully. Global competition. Write this down. The United States is not operating in isolation anymore. Europe is advancing crypto frameworks. Asian financial hubs continue experimenting with tokenization and blockchain settlement. Middle Eastern sovereign entities are increasingly exploring digital asset infrastructure. This is becoming geopolitical. Historically, when nations compete over financial infrastructure, innovation accelerates. That happened when maritime trade. That happened with railroads. It happened with the internet. Financial dominance has always been tied to infrastructure leadership. Some analysts believe blockchain settlement networks could eventually become part of that competition as well. Again, not guaranteed, but increasingly relevant. And that may be one reason policymakers appear more willing to discuss integration than outright suppression, because no major economy wants to be left behind during infrastructure transitions. Now, does that mean XRP automatically wins? No, ladies and gentlemen, absolutely not. There are competitors in this space. There are technical challenges. There are adoption hurdles. But the broader environment becoming more receptive to blockchain-based payment infrastructure is directionally important for XRP's long-term narrative. And that's really the key takeaway from this week. Not hype, not moon predictions. Structure. 3 major shifts happened almost simultaneously. Macro liquidity conditions strengthened. Regulatory clarity discussions accelerated. And policymakers opened signally interest in making crypto payments easier. That combination matters because for years, crypto operated largely outside the traditional financial framework. Now that conversation is slowly becoming, how do we incorporate this into the system? That's a fundamentally different phase of the market. And if this trend continues, the next crypto cycle may look far more institutional, far more regulated, and far more infrastructure focused than previous cycles, which could dramatically reshape how assets like XRP, the anointed one, are viewed moving forward. Now, whether that ultimately leads to massive adoption or not, that remains to be seen. But ignoring the structural signals entirely, that may become increasingly difficult because the narrative is evolving, the regulatory environment is evolving, and the financial system itself may be evolving alongside of it. That's the biggest story most people still aren't seeing. And honestly, we may still be very early in understanding where all this leads. If you made it this far, drop a comment below and let me know. Do you think the crypto is moving towards true institutional integration, or are we still years away from that transition? And if you enjoyed this breakdown, make sure you subscribe, hit the like button, and join the Wolf Pack, because we're tracking the macro shifts, the institutional signals, and the structural changes most people overlook. Always do your own research. Never invest solely based on YouTube videos. And remember, short-term noise, long-term structure. I'll see you in the next one, ladies and gentlemen. Good morning, everybody. Hope everyone's having a blessed morning. A lot of things to go over real fast. I want to welcome all the new members of the Patreon, the Crypto Republic Desk Monthly, all the new members of the membership channel. Like we said yesterday, ladies and gentlemen, disappointment in tweets will move the entire market. If you're paying attention to this, and if you're new here, do subscribe, because when we get to this point in our videos, it's the candy from the Italian ice. We have an update that's going on with today's financial situation, our PITS perspective, and our daily financial combat update, and they build off of yesterday's or the last video. So look, we went over how the market is being moved by tweets like a sailboat with wind. You can see that right now. Disappointment and nothing's going to get signed. Blah, 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 blah. What happens? Complete reversal. I want you to understand something, and this is very important. CEO Sultan Al Jaber warns Gulf oil flows could take at least 4 months to recover to just 80%, okay, of pre-war levels. Even if the Iran conflict ended immediately, reopening Hormuz is not the same as restoring normal flows. Write this down. You need to drill this into your wall so you understand this, because most people are going to get caught up like sushi because they just have no map of where they're going. Again, tankers, LNG cargoes, pipelines, storage systems, and damaged infrastructure all need time to restart. Markets may be underestimating how long the supply shock could last. This is really, really important. U.S. gas demand is about to grow faster than any other period in history. We've been talking about this, the kilowatt wars, the AI battle, how it's all about commodities. Almost all of it's LNG power. 2025, 2031 forecast, 27 BCFD of new demand. That's the largest single period increase on record. Trying to take the PhD out of PhD of everyone. Ladies and gentlemen, the two drivers of this, LNG feed gas, the dominant contributor, new export terminals, they're coming online through 2030, but they need gas. Power, AI data centers, electrification are pulling more gas into the grid than any point in the past decade. The next wave of U.S. gas demand is export-driven and electricity-driven. Both are structural, not cyclical. Ladies and gentlemen, I've been talking about this for a long time. Again, if you look at where the cryptos are behaving right now, they're keying off of risk. What I am spending a lot of time going over is the entire risk scenario. Will interest rates be cut? How does that affect crypto prices? Incoming Fed chairman, what does he want to do? Does he want to shrink the Fed's balance sheet, aggressively cut rates, or a combination of both? The United States has to print itself out of this situation. We have to export out of this. But again, we have been harping here for months that the only way to win the AI conflict, the kilowatt conflict, is natural gas. The Middle East is never going to be the same from a standpoint of energy, business as normal. Anybody who thinks that is snorting bath salt. And we'll get cut up like sushi. Because, ladies and gentlemen, there's a uranium secular bull market happening. If you want to understand and see how AI is power hungry, the Hormuz shock and a 1.7 billion pound supply deficit are converging to create the energy trade of the decade, join the Crypto Republic Desk monthly and join over 550 active traders and investors who have decided to take their own financial destiny into their own hands and learn and become a financial mercenary. Because everything I go over every day is the compass, the latitude and longitude coordinates of how to take advantage of where all this is blowing. All you need to know is the AI power squeeze. Data centers and hyperscale AI training require 24/7 firm dispatchable baseload power. U.S. electricity consumption from data centers is projected to surge from 4 to 5% today to over 12% by 2030. That's massive. The Hormuz shock, the 80-plus day closure of the strait, has triggered the largest energy supply shock since the 1970s, proving that imported hydrocarbons are geopolitically fragile and accelerating the global push for domestic nuclear security. Structural deficit, global uranium demand is expected to reach 141 million pounds annually by 2033, while new mine development lags by 18 to 15 years. That's so massive right there. That's a home run. Nobody's paying attention to this, but we are inside the Crypto Public Desk monthly. The cumulative deficit could exceed 1.7 billion pounds by 2045. Incentive pricing required. With spot uranium near $86 per pound, consensus targets indicate prices must reach $125 to $150 per pound or higher to incentivize the new supply required to balance the market. Ladies and gentlemen, the leverage play, uranium miners and developers offer massive operational leverage to rising spot prices, providing inflation protection and equity-like upside in a world of financial strain. So it's the perfect storm is converging to create the energy trade of the last several decades, and nuclear and uranium are supposed to be the big beneficiaries. Ladies and gentlemen, that's massive. See, these little things, like I told you yesterday about it's the commodities market, that's it. Look, Turkey liquidated all of its holdings of U.S. treasuries in March. They are massively and aggressively defending their currency. They have not done very, very well with this. And if you look at what's happening, they keep selling, and that's rough. You have to understand something. When countries are forced to defend their currency from some financial maneuver, it's not good. And it's causing pressure on their currency. That's why they're defending it. Now, when most people sit here and complain about how come they're not rich overnight by buying cryptocurrencies, they're not realizing that the cycles that created the cryptocurrency to take off last time are being set differently now. That's why I said the commodities market, everything's keying off of. That's just what it is. We've gone into a commodities bull market. This is the last time we saw this. I remember my career in the early 2000s. This is before the subprime meltdown. So if you're looking at what's happening, you have to go back before the subprime meltdown and see what the world was like. Every day I give you tidbits of what we're following and what we share with people that retain us in any capacity to show them where the world is moving. I've spent more than half my life in the financial arena on the floor of the commodities exchange. All I know is commodities. All I know is to be a financial mercenary. I love giving back to everybody because this is a chance to be free financially if certain cards are played right with what the world is giving us right now. You don't see many transitional situations like this. They come every 20 years. And when they come, the people that position themselves in those space really, really benefit from it. Really, you're talking about generational wealth. You're talking about financial freedom. Look at anyone in the mortgage industry when interest rates were zero. Even people like myself in the Forex market, the commodities market with the carry trade. Everybody loves talking about the carry trade. I want to know how many people who talk about the carry trade ever did trades using the carry trade. When you used trades to make money using the carry trade, you understand really functionality, what it does and why. Again, the only competition that people are always in is with their bank accounts and to get ahead. The world's going to change one way or another. And if you look at going back to when I first started ranting on our channel, I would point out to some of the most powerful families that the United States has ever seen in its history, the industries that they bought and what they did and why. If you look at what the Rockefellers did, and none of this is financial advice, just my own opinion and retain this in any capacity. At one point in time, they gobbled up almost all of the local pharmacy businesses and changed the entire way pharmaceuticals were done. They had basically changed what you had access to in stores. They just gobbled them all up, acquired them, purchased them, and put different types of remedies inside of it. All the remedies, that's where the word pharmaceutical comes from. Most people didn't know that. So when pharmaceuticals came about, they changed everything around it. They also then went on to acquire newspapers, acquire boards. Anybody that didn't want to get involved with the medicines that they were offering and offered a different turnkey solution for people looking for health were kind of labeled as, at that time, nuts. Why I bring this up is when we track, and why I say we're the remora underneath the apex predator, feasting on the sushi, and we will not get cut up like sushi is, we're doing what the apex predator does. We're not reinventing the wheel. We're not trying to get lucky. If you see the powers that be, what they're doing in the world right now, you just have to sit patiently and wait for it. It's not easy for most people, I get it, but you have to just wait for it. That's why we talk about XRP, ICP, HBAR. You have to wait for it, ladies and gentlemen. I love you all. I'm going to see you on the front lines. I'll see you in this afternoon's video. This content is for informational entertainment purposes only. Should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions always. Remember, the game is changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You have two choices. You can be like the crowd reacting after the move, rationalizing why they missed it, telling themselves that it'll never happen again, or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet right up until the moment they're not. And this is one of those moments. Do not blink, because the world is distracting you with noise, while XRP continues developing behind the scenes and building momentum in the broad digital asset landscape. Stay sharp, stay informed, accumulate knowledge. You move now, be remembered. This is not the end of the story. This is just the beginning. This opened your eyes, smash that like button, ring the bell, and leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to the Crypto Republic. We break down the major global banking trends shaping digital assets today, giving you content, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the public. I love you all. See you this afternoon. Don't get caught up like sushi.